We start today's market talk easing input inflation to drive consumption. This is the basic premise on which any future rally has to be based on. And why it is so? It is because the long shadow cast by Middle East crisis on India's economy appears to be receding quite rapidly. Energy prices, commodity prices, fertilizers, urea, metals, rubber, vegetable oils, chemicals have all seen prices soften, and it also helps the government because it lowers the scenario of higher subsidy burden on the government. Hence, automobiles, consumer durables, FMCG, construction products, aviation will all benefit. This is the basic premise for the consumption led rally, which is likely to take place because all these stocks were the most punished. Now, market outlook, there are few things which are happening. One, AI boom is shaping a new world order. So the winners of AI boom are US, China, etc. due to their foundational AI models. Taiwan and South Korea on the strength of chip manufacturing, and just see the Kospi index. See from the levels of around 2,500 odd in 2025, it has nearly reached 9,500 and then it has corrected, but it's very normal. It goes, and if you see, it is making a clear five-way structure, right? See, this is the first wave. This is wave two, wave three, wave four, and it corrects around 20%, takes support. So mostly it will take support around here, and then again start the journey because this is a long-term theme. Uh, then Japan and Israel on broad AI skills. Meanwhile, Europe, India, and Philippines are in the red as they are not participating in AI infra and services for this year. I am talking about the year to date returns of the basis indices in these countries. Next is Indian IT companies have been hit hard. Now, Nifty IT index has corrected 5% since Accenture's earnings. Now, I'll show you the IT index. This is the where the Accenture's earnings guidance came, and index has corrected 5%. And you see, it went to the long-term support it had, IT index, somewhere closer to 26,000, and then it has rebounded from there. And then what happened is, then KPIT issued a warning on 1st July about revenue decline and margin contraction. So that took the ER&D companies down because the normal IT services companies have a wide portfolio like TCS, Infosys, etc. But these guys are focused. So the reason was European automakers BMW, Volkswagen continue to face weak vehicle demand, slowing EV adoption, and aggressive competition from Chinese manufacturers. So until discretionary technological spending bottoms out and it starts improving, this sector will continue to trade without a clear catalyst. So this thing will continue. It'll see rallies from the beaten down levels and then will sell off. Now, among the IT stocks, HCL Tech rose last week because it got a 1.14 billion contract with a Europe uh, global company, Fortune 500 company, and basically probably it is Mercedes for which they have got this contract, and this contract can extend because this account was previously held by Infosys. So actually they have posted into a contract of Infosys. So if HCL Tech is going up, then Infosys will also come down. So it is the same. Overall, it's not a new contract or something like that which is happening. Now, what has happened is soft US job numbers and lower energy prices have led investors to scale back bets on monetary policy tightening in the US. So, job numbers were soft and lower energy prices. Both crude has come down to around 72 odd level. Now, this tends to be a headwind for non-yielding gold. Like the policy tightening was the headwind which I had covered last time. Now that risk is off, and gold is now rebounding. So if you see here, US 2-year yield, which is immediately impacting the rates, has corrected a bit. Brent crude has come down to roughly closing at around 72 odd, and it can come down more. Uh, a geopolitical risk premium is wiped out. So here the support is somewhere right now around 68, 69. So that should help. Then gold. So if you see here, gold had taken support at around 4,000, and now it is moved up around 2%. So heading right now to $4,200. Support is at around 3,960 to $4,000. So it has moved around 1 or 2%. Similarly with silver, it has also taken support at 56, 58 levels, and now it is heading to around 65. And Bitcoin also, it has also taken support somewhere around 58,000, where crypto ETF started selling. So support is at around now 60, 61,000, and it can go up to 65,000. So this is what is the net result. So if you see here, so these are the three things which are taking place. One, AI boom is definite. This is how the new world order is likely to get shaped. Indian IT companies will be hit hard, and now the expectations of a rate hike in the US have reduced. So the bond yields are going to come down, and gold, silver, cryptos, etc. will start moving up. And in addition to this, dollar index will also come down. Now coming to FIDI data, this is very interesting. So if you see here, what is happening is FIs have increased their or have a short in index futures. They bought Nifty futures and they sold Nifty bank futures. That is why I had mentioned that there is no momentum in Nifty bank, because there they are adding shorts, while Nifty we saw some short covering oblique buying of future positions. They have sold calls in index and they have bought puts. So they are strongly bearish. Pros, if you see, they are long in index futures. They have bought index call options and they have bought put options. So they are indecisive or neutral right now. Don't know which direction they will go. Clients, if you see here, they are long in index futures, bought call options, index call options, and have sold puts So they are strongly bullish. And on Friday, there was a lot of block deals, etc. So you can't really make out this thing. But the DI sold roughly 2,000 odd crores. Now this data is more interesting for the month. So if you see here, the expiry took place on 30th June, right? So on 29th June, that was on Monday, the FIs had 2.34 lakh short positions in index futures, and instead of short covering, they added to their short positions on the expiry day and have rolled over most of their shorts. So the short positions became 2.56 lakh. It increased a bit and now it is stabilizing because they did some short covering uh, in the last 2 days. So the index also moved up. Otherwise, it was declining. So there is no change of stance of the FIs or whatever it is, and that's why the Indian markets are at whatever place it is. Now coming to other issues, US dollar Indian rupee weakened a bit, so it has now come to the trend line level. The bond yields in India came down, so that is good because the rate cut expectations have reduced. Sorry, rate hike expectations have reduced, and hence it is now correcting and below the trend line. US government bond yields, 10-year yield moved up. It's generally moving in this range right now because long-term fiscal concerns remain. So over a long term, there are concerns. So short term, it is coming down, but long term, there's not much of change. Dollar index corrected a bit, declined with the bond yields, but above 102, it is bullish and support at around 100. Copper consolidation right now, nothing substantial taking place. S&P 500, so uh, bro- broader market participation is taking place in US, hence it is balancing the technological drag which is taking place in the Magnificent Seven and other stocks. Nasdaq uh, corrected, but then it bounced from the lows. So it is somewhere closer to the rising trend line level. So they are, it's just a kind of a correction right now. Nothing much is happening. There is some fatigue in valuation and profit taking which is taking place. While Dow Jones made a fresh high uh, because capital out there is relocating to into financials and industrials right now. So it is just a sector rotation which is taking place. India VIX declined, so which was good, lowest level since February this year, and it is coming down, so the volatility should reduce. Nifty, if you see here on the weekly, it was a bullish candle, uh, and it has moved up with both shadows on both sides. So after two dojis, after 2 weeks, so there is some positive intent which is seen. On the daily chart, it had broken out from the declining trend line, and now if you see here, the 20 EMA is also trending upwards. RSI has improved to around 60 level, so which is good. And the first resistance should be this level of 24,450, and then to this high which it made to around 24,600 odd. So these are resistances, support around 24,200 and 24,000. Now, Nifty Bank on the weekly level, a small bearish candle with long shadows on both sides. So didn't move anywhere. It is facing resistance at around the 58,000 level. So Nifty Bank, if you see the daily chart, the structure has not broken, though just facing resistance now. It is just consolidating here. The 20 EMA is moving up. RSI is still okay, though it is declining a bit. Uh, Falling momentum. So the momentum is going down. So 5,800, 58,400, 58,500 should be the resistance and support at 57,500, 57,400. So nothing substantial is happening here. Midcap was up 0.77%. It is closer to the highs. So if the momentum continues and the consumption-led rally continues, so it should go up. Small caps moved up, were up 2%. So this was the best performing sector. RSI is above 60 and trending upward. So there is good momentum here. Now HDFC Bank has closed above 800. So it is finding a problem to go above 800, trade above 800. So the resistance high it made was 807, which is also the 20 EMA. So it is at the resistance right now. Once it breaks above this, it can head to 833. The business update was decent. RSI is moving up, showing some momentum. So this is looking better right now, but it is consolidating. Reliance stuck at 1300 out levels. As I had mentioned, it is not able to go above this 13. The resistance it is facing at 1310, 1315. So this is stuck here, and I think they will wait for earnings or some positive announcement. Now, the stocks which have corrected are Hitachi Energy. So this is, if you see the daily chart, it has retraced 38%. So this should be the first support, that around 30,000. So this should be the first support. RSI is also nearly reaching oversold levels. So it should find support here and should bounce. And this is what happened on Friday also. But if it breaks this, then it will head to 26,000 or this 27,475, that 50% retracement. So this is that normal correction which takes place, and that has played out. Now GE Vernova, if you see, it has also taken support at 100 EMA at around 4,400 and then bounced from there. But it since the rise was steep, it has fallen steep. So it has broken that 38% retracement support and has actually gone below. So it may head to around 4,000 levels also on a bad day, and it has come down with large volumes. RSI has also come down. So let's see if it finds support here at 100 EMA, which is around 4,328. Now I cover two stocks. First is Cart Trade Tech. It's a asset light ecosystem. It runs a asset light ecosystem, relies on three distinct pillars that feed a classic platform network effect. First is consumer segment, that is car wale and bike wale. Remains the largest top line driver, monetization via OEM advertising and consumer led generation expanding faster than the broader digital marketing market. So this is where the OEMs put across and do the advertising, and depends on the OEM advertising budget. Next is the classified and remarketing, which is OLX India and Car Trade Exchange. The strategic acquisition and integrations are playing out beautifully. They had acquired OLX India. Car Trade's partnership with lenders like mid 2026, they have tied up with IDFC First Bank for integrated used car financing via OLX is capturing multi-point monetization per transaction. So what they are doing is they are trying to increase the financing part in the used car and into the appliances also, which are sold via OLX. Then there is a B2B auction engine, expanding gross merchandise value as institutional fleets and unorganized dealers shift heavily to organized digital liquidation. So they are expecting a lot of unorganized dealers will shift to their platform. So what is changing is, unlike the previous business model where revenue was generated largely at the point of lead generation, the company is now positioning itself across the entire vehicle ownership lifecycle from discovery, financing to ownership and eventual resale. So, what are they doing? Now they are into discovery. That is, they will help you find your desired car, then finance that car, then help you in owning that car held by dealers, and then get into the eventual resale market also. Used car financing through OLX India offers a sizable monetization opportunity across a large underpenetrated user ecosystem. It could become the largest incremental earning opportunity over the next 5 years, expanding monetization without taking balance sheet risk. Now, what is happening here is that the risk of lending the money is coming to the banks hen or the NBFC. So what will happen is that there is no risk to their balance sheet. So it remains asset light. The car doesn't comes to them. They are just a platform for the sale, and the lending is taking place by a bank like IDFC First. Car Trade operates an asset light auction model that earns transaction based fees without assuming vehicle ownership or inventory risk, resulting in superior capital efficiency and strong cash generation. Its strategy is now evolving towards participating across the entire transaction lifecycle by integrating AI-powered advisory, embedded financing, inspections, escrow, logistics, warranties, and premium subscription services. It benefits from 95% plus organic traffic, allowing incremental revenue from AI financing and transaction services to carry substantially higher contribution margin. See, they don't have to spend money on customer acquisition. They will use AI and other methods to increase the spend of each customer. They have adequate customers. So most of the startups spend money on customer acquisition. First time if you come onto their platform, they will give you a discount, right? Or the first transaction is free. So that is basically customer acquisition. They don't have to do that. So that advantage accrues with them. It is delivering a 29% revenue CAGR, 98% EBITDA CAGR, and 82% PAT CAGR during FY23 to 26, while EBITDA margin expanded to 33%, highlighting the scalability of asset-light operating model. Digital automotive marketplaces globally have demonstrated that the highest earning growth is achieved after user scale has been established. So they have got the users. Now they have to sell them more or make them transact more or go through the complete life cycle of a vehicle. when businesses begin monetizing transactions rather than merely facilitating discovery. Right now, they are only being priced as a place where a person discovers a car. And in case they establish a sale, then they get some more benefit from the uh, OEM. So that is the business model. Now, so they have divided themselves into three parts: consumer group, car wale, bike wale; remarketing group, where they do this exchange of old cars, etc., finance through Shriram, other inspection services, etc., and OLX India, where they do these used classified businesses. So these are the three segments. Now they have launched a AI app called Via, and 15 plus agentic AI solutions mark the beginning of an AI-led transaction ecosystem covering vehicle discovery, price benchmarking, inspection reports, financing recommendations, negotiation support, and ownership assistance. Rather than functioning as a generic chatbot, these solutions are trained for on decades of proprietary automotive pricing, inspection, and transaction data sets, providing a competitive advantage that is difficult to replicate. You see, in anybody can make an app, but the data set which they have is the actual moat or competitive advantage they have. Now, first is for new auto, they have decent apps for every step of new car buying. Then used autos, so they have these apps. Retail, reimagine the buying experience, so they'll help you to buy a used vehicle with inspection and other things tied up into that. And then OLX, where they have their own system of elite buyers, elite sellers, and verification system. Then matchmaking agent, pricing agent, condition agent of various stuff. So that's why they are using all these apps. Now in their revenue mix in FY26, consumer part, that is car wale and bike wale, was 40% of the revenue. Balance was remarketing and classified OLX. And similar was the setup in Q4 FY26 also. So right now, the consumers part is their major revenue stream, and these are growing. The others are growing. So if you see here, the remarketing is the one where the growth is coming. They did 71 crores of in FY26, while consumer has come down a bit, done around 80 crore, and OLX is also around 55 crore. And but you see the EBITDA margins are the highest for consumer group, and then remarketing is improving, and the OLX is also improving. Now, quarterly revenue trends, decent, 200 odd crore they are making every quarter. Margins are improving. Yearly revenue is improving. See the trajectory, and EBITDA margins are also improved as they become uh, more focused and able to monetize the resources they have. PAT margins have also improved, and see the trajectory over this is the quarterly, and if you see over the years, the profit has grown. So roughly FY26 to 43 crores, and profit margins have improved. So they are able to monetize. That's what I said. There is no uh, customer acquisition cost, and this is one of the among the few tech stocks in India which are profitable. Others are not profitable. So that is the advantage, and now they are monetizing that. Now if you see here, they did around 779 crore of revenue or gross sales in FY26. They are expected to now have a steady growth of around 20% in terms of revenue. EBITDA growth is around 30% plus. Margins are likely to improve, and PAT is also improving at the same. PAT margins are improving, and PAT will also improve at around 30%. So it is 20, 30, 30. You can say the business. Adjusted EPS FY27 is expected to be 61 and 80 odd in FY28. 80 odd EPS in FY28, 40 times is simple if they are growing at 30x for 3 years, 30% CAGR. So you can easily give up people are being valued at much less at 40 times. So that straightaway takes it to 3,200. Now, this stock had reached that 3,200 level, corrected from there because of the threat of AI, became half, and then now it has started moving up. And now I think they are waiting for this quarter's earnings. So if you see here, as I said, it is right now at around 33 times FY28 earnings, around 12,964 crore market cap. So what it is doing is moving from lead generation business to entire auto transaction life cycle. Right now, used car financing is just 20-30% financing part. It can increase to 75 to 80% for new vehicle, for these vehicles, for used cars. Revenue, EBITDA, EPS to register 20, 30, 25% over the next 3 years. Since 95% of the platform traffic is organic, they don't have to do it, is there. It reduces customer acquisition cost. Earlier business model was OEM advertising and dealer subscriptions. Now it has and auction commissions, etc. Now, earlier, so it has improved now, because earlier earnings were influenced by OEM advertising budgets and automotive industry volumes, because sale, if there is sale, then only they will have revenue. Now it has changed. uh, OLX has 25 million, that is 2.5 crore plus annual listings. It spans electronics, mobiles, furniture, and other used good categories, allowing same financing and AI and transaction infra to be deployed. So they can include the financing part in these items also, if somebody wants to buy them. So there is a big scope for them, and the advantage to them is their data. Now the next stock is Clean Max Enviro. It's a recent listing. It is India's largest commercial and industrial renewable energy provider with an estimated 12% national share, 3.1 gigawatt of operational power sales capacity, and 5.7 gigawatt contracted portfolio at end FY26. It supplies firm priced green power directly to 588 corporates under 23-year bilateral contracts at 30 to 45% discount to grid tariffs, and does not bid in utility auctions. Now you must understand this. The If you are paying 5 or 6 rupees per unit for electricity, the corporates are, or the industry, they are paying, if they take from the grid discoms, they are paying 10 rupees, 9 rupees, 12 rupees, etc. And the agriculture and the consumer is being subsidized because these guys are paying high. Now they are at discount to that, and they are off the grid. So people go to them. The relationship driven model differentiates it from tender based peers, with 74% of the new capacity sourced from repeat customers, over 95% of the book rated A minus or better, and no contract renegotiated against the company since inception. So their history is good. Critically, data center and AI customers already make 42% of the contracted book, placing it at the center of India's hyperscaler build-out. Economics also beat utility renewables, with realization near 3.8 rupees kilowatt hour against 2.5 kilowatt hour at auction, and a 47% EBITDA CAGR over FY23 to 26. A capital light model supported by group captive structures and co-investors such as Apple, Osaka Gas, and Toyota Tsusho enables stabilized projects to generate 34% cash ROE. Now they are getting into these capital models where Apple and others are co-investing them along with them to set up the green power infrastructure. Now, about 1.87 gigawatt backs global emission offset deals of big tech, that is Meta, Google, Amazon, and Apple, and 0.51 gigawatt supplies to India-based data centers of Cisco, Equinix, STT, NTT, others, giving it an estimated 35 to 38% share of India's hyperscaler energy deals. Capacity is contracted before it is built, so there is no spare capacity. Now, 5.7 gigawatt book, of which 2.6 gigawatt is under execution at about 3.85 kilowatt hour, plus a broader 11.8 gigawatt portfolio with a secured or applied for connectivity underpins operational capacity rising to about 7.8 gigawatt by FY29 on at least 1.5 gigawatt of additions a year. I'll show you the how it will help their EBITDA very simply. So let's remember this 1.5 gigawatt of additions a year. They are talking about right now, uh, which is roughly 1500 megawatt. While a company, now what they did is they got 1122 crore of fresh IPO proceeds to prepay repay debt, and capital intensive nature of the utility model keeps the debt to equity ratio around 2.73x. So that is the only red flag. You have to watch the debt. Promoters hold 49.48% of the equity, out of which 20.02% is currently pledged, adding a layer of structural vulnerability during sharp market corrections. So these last two, that is debt and pledging, are the risks. Now I'll explain to you how to measure this. So if you see, the capital expenditure is roughly 3.5 crore for solar per megawatt and 7.8 crore for wind. Now, EBITDA they make is roughly 50 odd lakhs per megawatt of solar, and for wind they make around 100 to 110 or 1 odd crore. So 50 lakhs per megawatt in solar and 1 crore in wind. Roughly the ratio is 80-20 or 75-25. So predominantly the capacity they are adding is solar. So if they are talking about say, let's assume at 60 lakhs also. So if they are talking about 1.5 gigawatt to be added per year, it will add to an EBITDA of roughly 900 crores per year. 1.5 gigawatt added per year will add to an EBITDA of 900 crore per year. Now I'll show you in the next March stock. So plant load factor is good for solar, and wind is much better. Net debt is a problem uh, right now, and EBITDA margins have improved. Tariff roughly 3.8 rupees per gigawatt, which they have already done or uh, tied up with the guys. So if you see operational highlights, now, see, this is the contracted capacity 5.7 gigawatt. Present capacity operational is 3.1. Under process execution is 2.6. Till now in FY26, they have commissioned in FY26, they commissioned 1.4 gigawatt. Now, FY26 total EBITDA is 1295 crore. So we had counted they will add 900 crore of EBITDA every year, even if they do 1.5 gigawatt at the present rates. So you should remember that 900 crore in EBITDA getting added every year. The cost of project debt has come down. So now it is 8.5% versus 9.2% on in April, because their credit rating etc. has improved, profit etc. has improved, receivable days are better. Q4 they did 350 crore. So this every quarter it should improve roughly around 200-300 crores. It should improve if they do around 1.5 gigawatt. Plus their existing resources will also make them give earning. EBITDA CAGR is 32%. So this is what they have done. 42% is contracted for RE power sales capacity to data and AI customers, while 74% of new volumes contracted with existing customers, repeat customers. So that shows that they have long-term contracts. So if you see here, data and AI continue to be the key growth themes, strong growth across segments. Now, so they have done 3x growth in contracted capacity, 42% capacity for data and AI. So data and AI customer in last 2 years have grown 10x, while conventional customers have increased 2x. So 517 megawatt contracted, including new customers, Princeton Digital, Iron Mountain India Data Centers, STT Global Data Centers, etc. And for conventional customers, which are industrial, they have repeat customers like Ultratech, Cement, Apar, BSF, new customers such as Gujarat, Alkalis, and CET, etc. Now, they recently did a deal with Meta to provide them clean power for their plants which are coming up. So total portfolio with Meta is now 900 megawatt. So they have recently did a deal with them, and that's why the stock was in news. Now, if you see the financial results, quarterly they did 25% revenue growth, 32% adjusted EBITDA growth, and 164% PAT growth. Now, the problem is this is in millions. So if you see here, the uh, the work in progress has increased. So this is the money which is capital which is blocked in work in progress, 5,400 crores or 339 crore, and net debt have also increased roughly 50%. Now it is 9684 crore. So growth is there in the balance sheet due to increased capacity commission and under construction, but it is also increasing the, and equity is also increased because they did an IPO, etc. But there would be threats of constant equity dilution once they can't take more debt. So if you see here, the consistent improvement in weighted average cost of project borrowing, so it has come down to now 8.5% as the credit rating has improved. Leverage is conservative, but debt to adjusted EBITDA and DSCR, debt service coverage ratio is 1.3x. Now, debt service coverage ratio is EBITDA divided by interest and principal repayment. Now, the problem is that the key figure here is 1.15. Below 1.15, it can trigger a technical default. So the problem is that you have to watch how their earnings are growing and how their debt is growing. So that has to be seen. Now, FY27, if you see here, is a problem because of two things. One is a transition year with high depreciation and interest costs from newly commissioned projects, temporarily outpacing revenue recognition. As assets mature and utilization ramps up, operating leverage should drive an improvement in profitability for FY28. So FY28, they're expected to do around 4,200 odd crores, 300, 4,200 and roughly 3,000 crore of EBITDA. As it will grow exponentially once the capacity comes up. Interest expenses are going up and adjusted PAT of 362 crore in FY28. So right now their market cap is 14731 crore. So FY28, if they do around 362 crore of PAT, they are at around 41 times FY28, and that expensive. So revenue is expected to grow around 50%. EBITDA is growing at around 60 odd percent plus. So that is a good part. So one has to watch what is happening with their debt and interest coverage. EV EBITDA is also decent. Net debt to equity is rising. So that part one has to watch, and equity dilution. And EBITDA margins are improving. So that part is good. Now, what happened with this stock was CleanMax Enviro. It listed, muted is listed at around 700, 800 odd on the first day. And subsequently, it corrected a bit. And then with the more knowledge and funds buying it and all, it went up. Now again, it went up after the Meta deal, and it corrected around 6% on Friday. I don't know why. So it has come down. So one has to keep this stock in watch and wait for earnings, etc. So if you get it at decent price, somewhere around 1100 or $1,000, that gives you adequate margin of safety for anything which goes wrong over a quarter, etc. Because anything can go wrong anytime. Some project can get cancelled, government regulation can change, etc. So remains very vulnerable. They did this utility scale solar and wind projects with Meta recently, and that's why they were in news, and that's why the stock went up to around 1500. The point is that it's a very competitive field, and in this field, though people will like to go with the same service provider and known names who are able to execute, so that has to be seen. As I have spoken, the industrial tariffs are at around rupees a kilowatt hour in India. So people like to go for lower ones, and these guys are directly providing it. So one has to see that revenue and EBITDA CAGR are strong. So 48%, 63% revenue and EBITDA CAGR over the next 3 years. So that's why this stock, though looks expensive, but if earnings are going to be bad over FY27, so you can see and since this is recently listed, so there would be a lot of liquidity events also. So you will get a bad price on some day. So that is the time to buy this. As FY27 is a transition year, not much is expected. So market doesn't has that kind of a long-term memory. Somebody will sell big time or lose patience, and that should be an opportunity to buy at lower levels. But it's a stock for long term. I finished. We'll take questions now.